Welcome to Talk Tickers, where we break down the most important earnings calls. Today, we are digging into Skillsoft's Q3 fiscal 2026 results. And wow, this was a report that sent the stock into a total freefall, even though at first glance the headline looked, well, pretty good. So what's the real story here? Let's get into it. So, right out of the gate, we see this weird paradox. Skillsoft reported on December 10th, and look at this, a solid beat on adjusted earnings per share. You'd think that's great news, right? But they missed on total revenue. And that right there is your first clue that something much more complicated was brewing just beneath the surface. And the market's reaction? Oh, it totally confirmed it. In those first few minutes after the report dropped, the trading algorithms, the computers, they just saw that EPS beat and nudged the stock up a bit. But then the humans got involved. Once actual analysts started digging into the conference call and the nitty-gritty details, the stock didn't just drop. It completely collapsed the next day. So what on earth did they find? Let's unpack the story behind these numbers. Okay, first things first. Let's really look at those headline numbers. These are the metrics that created all that initial confusion, and they're our starting point for this whole investigation. All right, here we go. That adjusted EPS of $1.65, a clear beat over the 126 consensus. That's the number the algorithms loved. But take a look at the whole picture here. Revenue comes in at $129 million, missing the target, and crucially, it's down 6% year over year. Then you've got adjusted EBITDA, which is a really key measure of a company's core profitability. Well, that dropped a painful 12%. And this, right here, is where the real analysts started to see the cracks forming, and all that initial optimism just vanished. What's really interesting is that management themselves basically told us how to think about this. They framed the company as a tale of two businesses. And this, folks, is the absolute key to understanding why the market reacted so harshly. They essentially drew a line in the sand and said, look, we've got a pretty good core business, and then we have this problem child. And that problem child, it has a name, the Global Knowledge Segment, or GK for short. Now get this, GK was responsible for almost 3/4 of the entire company's revenue drop. Let that sink in for a second. This one smaller part of the business, just about a fifth of the total company, caused nearly 75% of the pain. We are talking about a serious anchor weighing the whole ship down.
This chart just lays the conflict bare. On one side, you have the core business, TDS. It's the bigger piece of the pie, and it's pretty stable, only down about 2%. Plus, look at that dollar retention rate of around 99%. That is fantastic. It means their customers are sticking around, but it's being dragged down by GK, where revenue didn't just drop, it plummeted almost 18%. It's gotten so bad, in fact, that the company had to take a goodwill impairment of almost $21 million. Now, in plain English, that's just accounting speak for admitting, oops, we paid way too much for this business and now it's worth a lot less.
So, you see, the big issue here wasn't just about a messy Q3. No, it was about the huge, massive cloud of uncertainty that this GK problem cast over the company's future. The past was bad, sure, but the future? It just became a complete black box for investors. And on the conference call, you can bet the analysts jumped all over this. This question here gets right to the heart of it. They're basically asking, okay guys, what's the plan? Are you going to try to get a good price for GK? Or are you just trying to dump this thing as fast as you possibly can, no matter the cost? And let me tell you, management's answer, or lack thereof, is what really sealed the stock's fate. Yeah, instead of giving investors any clarity, they did the exact opposite. They pulled their full-year financial guidance for the entire company. Pulled it. To an investor, that is a giant flashing red flag. It basically screams, the situation with GK is so volatile and unpredictable that we have no idea what the whole company is going to look like just a few months from now. And it gets worse. This was all made so much more painful by a really nasty swing in free cash flow. We're talking about burning through nearly $24 million in cash this quarter. So of course, they had to slash their full-year guidance for cash flow, slashed it from a healthy $13 to $18 million, all the way down to pretty much zero. The only guidance they were willing to stand by was for the core TDS business. It's like they were asking investors to please just ignore the part of the business that's currently on fire. So, once the full story was out, you've got the messy quarter, you've got this one segment just bleeding cash, and a future that's a total question mark, well, the market delivered its verdict, and it was swift, and it was brutal. the stock cratered more than 21% on huge trading volume. I mean, the sell-off was so intense and so fast that it literally triggered an automatic circuit breaker, a trading halt, to try and bring some order back to the chaos. This wasn't some gentle slide downwards. This was a stampede for the exits.
And look, this one terrible day wasn't just a blip on the radar. It's part of a much bigger, much uglier pattern. Over the past year, Skillsoft stock has lost 2/3 of its value. 2/3. Meanwhile, the broader small cap market, the Russell 2000, is actually up over 8%. That is some serious long-term underperformance right there. All right, so after all that, where does this leave us? Where do we go from here? This is where we get to our investment thesis for Skillsoft. What does all this mean for the next earnings call and for the future of the stock? The whole story for Skillsoft now boils down to one single critical question. Can they successfully amputate the GK segment to save the healthy part of the company? It's really that simple. The bull case? It's a clean, quick surgery. They get rid of GK and what's left is a profitable, stable TDS business that investors can get excited about. The bear case? It's a messy, botched operation that continues to bleed cash and distracts everyone, maybe even long enough for the core business to start getting sick too. So for us, given the huge risk that they mess this up, the awful cash flow trends, and just the total lack of visibility into the future, our rating has to be underperform. There's just way too much uncertainty here to recommend jumping in right now. Now, what about a potential trade? Well, the opportunity isn't today. Right now, the setup is a distressed stock that's basically priced for failure. The catalyst we're all waiting for is a clear, definitive announcement that GK has been sold. So the trade? It's to potentially go long, but only after a clean exit is announced. Once that cloud of uncertainty is gone, the market can finally, properly value the good business that's left. The big risk here? Well, it's that they have to do a fire sale and get pennies on the dollar for GK, or this whole messy process just drags on forever, draining cash and killing any shot at a real recovery. And as always, our final and most important reminder, this is not financial advice.